Now this one probably is going to hit some type of target. There we go. So it hit 1-1. We're still in the position, by the way. And then at this point, you already want to highlight the second position. How to backtest your strategy correctly and how to develop a winning strategy. Hi guys, it's Cas. I've been on the show multiple times and also recently. And me and Cam had a discussion about developing strategies, etc. And we came up with the idea to do some form of a big workshop on the channel that's going to help you guys to build your own winning strategies and to do it correctly. So that's what we're going to do today. And let's dive straight into this. So what will you learn today? You will have a blueprint for developing your own winning trading strategy. You will have a blueprint for backtesting your strategy correctly, because a lot of people do this the wrong way. And you will learn about the importance of backtesting and the mistakes that most traders make in this process. So before I dive into exactly how you can backtest, first we need to answer the question, why even bother? And the first thing is going to be that you want to figure out if your strategy has worked in the past. And it's not going to be a guarantee for the future, but if you're trading a strategy that has worked in the past, it's a foundation, it's something to work on. If your strategy never worked in the past, it's not going to start magically working in the future. That doesn't make any sense. So it can give you a guideline to figure out what works, what doesn't work, and something you can build upon. Most strategies out there don't work. And by backtesting, you can filter out the stuff that never worked and build on the good stuff. You can know the performance metrics of a certain strategy. So every strategy is going to have good periods, it's going to have bad periods. And by backtesting, you're going to know exactly how bad those periods looked in the past, so you can learn from them, so you can mentally prepare for those periods in real time. To know when it works and when it doesn't, so every single strategy is not going to work every single time. If you have a trend strategy, it's going to make money when there's a trend. It's going to lose money when there's a range. That's for every strategy the case. So you cannot have a strategy that works in every single environment. That's just not possible. And most traders make the mistake of building a strategy and then overfitting it to make sure it works in every single environment. The better thing to do is build multiple strategies, one for trending, one for ranging, etc. Then you're diversified. But backtesting is going to help you to know when a strategy works, when it doesn't. So again, you can mentally prepare for the bad periods. It's going to help you save money because you're not going to trade systems that don't do well in backtesting. And it's going to help you to get an understanding of probabilities, which is going to help you with psychology. And you can filter out, as I said, the bad strategies. So let's dive into the actual blueprint. All right, so I've created an actual blueprint for you guys to follow to build and test your own strategy. It looks quite complicated, but I'm going to go through it step by step. So do take notes, maybe even print screens, and pay attention. So building a profitable strategy all starts with getting an idea. And it can be as simple as, I noticed that when the US 500, so the S&P, opens bullish, it tends to continue that way. It starts with reading an article. It starts with listening to an episode of Trading Nut and someone explaining something about their strategy. So it's just an idea or something you read that someone does successfully. Now, the first thing that you might notice here is it's vague. It's very broad. It's very subjective. I noticed that the US opened bullish, it tends to continue. It's very broad. So I wrote down, this cannot be tested like this. So the first step is getting a solid idea that makes sense from good sources. And then the next step is going to be formulating that idea, which means going from very broad, very vague to something specific and clear that can be tested. So for example, if the first 30-minute candle is bullish, you buy at the close with a stop at the low and you exit at a certain risk to reward. If the first M30 candle is bearish, you sell at the close with a stop at high and you exit at a fixed amount of R. We went from something completely vague to now something that can be tested. And in this case, I didn't write down a sell scenario. I did write down a bull scenario. And we now went from a vague bull scenario to a solid bullish scenario that we can test. And this is a skill that you need to develop to go from a broad, vague idea to something that you can test and something that's simple. because now you can start finding the best way to backtest this. Why is this testable? The first M30 candle is either bullish or bearish. There's no guesswork, no gray area. It's either this or that. You buy at the close, that's very clear. The candle only has one close. A stop at the low, there's only one low. So that's very clear. And you exit at a fixed RR. That's all very clear. And that's what I really want you guys to think about. Make it clear. The next step then is going to be finding the best way to backtest it. And this does depend on your strategy, because there are multiple ways to test things and to optimize things. And it's really a matter of finding the best way to test that makes sense for your strategy. So if your strategy is fully mechanical, like the previous example, so there's no gray area whatsoever, best thing to do, get it programmed and run an automated backtest. It's going to minimize the amount of mistakes you make. It's going to be fast and it's going to give you quick results so you can analyze. However, I do know that probably most of the guys or the people, guys and girls watching this, have a strategy that contains discretionary elements. And when that's the case, you cannot fully automate it because you cannot automate discretion. What you want to do is take a look at what you have and see if certain parts of your strategy can be programmed to make the testing as easy, efficient, and fast as possible. So take a look at your strategy. Maybe there can be a certain time period or a certain range or a certain piece of price action be programmed. That's what you want to do to get an indicator for that piece. And then you want to use the replay mode to basically don't use hindsight to look back on a chart, but actually use a replay mode using your automated part and your discretion. And then you can accurately backtest the strategy that's semi-mechanical, that has programmable elements, but it's not quite there in terms of being able to program. So hopefully that makes sense. So think about for yourself which type of testing would be best for you. All right, so before we're going to go into anything else, I want to show you how to manually backtest your strategy. So if it's not programmable, like I said earlier, you need to do a manual backtest using a replay mode. And I'm going to show you a simple example of a simple strategy and how I would test such thing. So the rules are quite simple. For a buy setup, if during today's London and New York session, price closes above the Asian range high on the M30 time frame, enter at a retest of the most recent swing high before the breakout, place a stop loss at the other side of the range and target XR. I'm going to dive into that a bit later. Sell setup is the opposite way. So if during today's London and New York session price closes below the Asian range low on the M30 time frame, enter at a retest of the most recent swing low before the breakout and place a stop at the other side of the range, target XR. What do I mean by XR? Basically testing a 1-to-1, a 1-to-2, and a 1-to-3. Not necessarily to find the best target, but see this as your initial test. So you want to see some profitability across the board, which is what you can call parameter sensitivity testing. I'm not going to dive into that at all, but really simple. If your strategy works with a 1-to-1, it doesn't work with a 1-to-2, it doesn't work with a 1-to-3, it doesn't work with a 1-to-1.5. The exit basically is what's determining profitability, and that's not really that robust. So that's why when I do an initial simple testing, such as with this idea, I like to do a simple test like this just to see, okay, is it profitable across the board? Because that already gives me some confidence in the basic idea. All right, so these are the rules. Now let's go to the chart.
Now, if you're loving the show and thinking, where can I go and trade? Why don't you check out my prop firm sponsor, Blue Guardian. Now, these guys have been around for ages. They've been sponsoring Trading Up for over a year. And some of the key features that make them so good is that they've got realistic profit targets for their challenge phases. It's only 8 or 4%. They also have a scaling plan up to $2 million. And they do profit splits of 85%, which is really high for this industry. They also have quick and reliable payouts and a robust reserve that makes sure those payouts are as seamless and smooth as possible. Now, if you're looking to join, go and check them out. But first, grab my coupon code TradingNut, all one word. You're going to save yourself 25% off at checkout. There's a link in the description. Go and click that now. Right, let's get back on with the show.
What you can see here is the euro dollar 30-minute time frame. I already plugged in an indicator to highlight the Asian range, which is what you can see in white. I used the replay mode using that button and then going all the way back. So we're now in the replay mode. Now,
didn't go back far enough. It's only April 2024. Obviously, this is not enough historical data. Generally speaking, right now, I test everything from 2007 all the way until now to have a very big sample size. But this is just to illustrate how I would do this. All right, so let's start. And as you can see, we have the Asian range building up right now. There we go. And now we have the entry. So at that moment in time, you're going to pause. Why do we have the entry? I highlighted the high of the Asian range. I highlighted the low of the Asian range. And for a buy setup, we would have a 30-minute close, which is that candle, closes above the high of the Asian range. The last high before the breakout is going to be this. That's the last swing high. So essentially, we're having a breakout retest strategy. Confirmed breakout, we want to have a retest of the high of the range and then continue. So that's where the entry comes. The stop loss was the other side of the range. And as you can see, I put it at 1 to 2, but we also want to see, okay, if we hit 1 to 1, do we hit 1 to 1? No, we don't. So this is a losing trade. So you go to your spreadsheet. I filled in all these things. I'm going to do trade 1, which was the 9th of April, if I'm correct. And this is all -1. So with every single profit target we took, basically, it all was a losing trade. So you fill in -1, which is -1R. This is for later. What you want to do here is check costs of the brokers that you trade with. So maybe you trade with prop firms, maybe your own broker, to see, okay, what is realistic in terms of costs. And then I usually calculate that in a form of R. So let's say spreads, commissions, swaps, etc., all combined give you 0.05 R as costs per trade, for example. But you need to figure that out for yourself. And then you basically need to get this, add the cost to it, and then you have the realistic results per outcome. And costs can play a huge part in your results. So do add cost and really find realistic costs by checking multiple brokers. All right, so that's the first trade. Let's go to the next one. There we go, Asian range. And I already filled in the trade. As you can see, again, the white part is the Asian range. The red lines is the high and the low of the Asian range. As you can see here, we tag the high, we break it, but we don't close above. So there's no long trade. Here, as you can see, we close below the low of the Asian range. The entry is going to be there, as this is the last kind of swing low created before we got the breakout. So we got the entry there, the stop loss at the high of the Asian range, and the target is all the way down there. And if we then play, you can see it hits our stop. So again, we're going to go to, it's the 11th, then this was probably the 10th. It's going to be trade number 2, and again, -1, -1, -1. That's it, on to the next one. And this is how you test something that you cannot fully program. That's kind of discretionary, but as you can see, there is an element programmed, which is the Asian range indicator. So before you start manually backtesting something, really think about, okay, this cannot be programmed, but are there parts that can be programmed that can make my life easier? Because now I don't have to check the times. The indicator is going to tell me exactly when the Asian range starts. I can hit play, wait for the white part, and as you can see, that's the next trade. Again, let me clean this up a bit to show you what I did here. So it's really, really repeatable. Again, Asian high is this red line, Asian low is this red line, last low pre-breakout is that level, stop loss at the high, and off we go. And now let's see what it does. And as you can see, this was a 0, so a missed trade. Why? Because the entry was here and we just didn't get a fill. If you take a look at this candle high, it didn't reach out that low. So, we didn't get a fill, which means, and the next session starts, and if we go back to the rules, it has to happen during today's London or New York session. Didn't happen there. So again, you go to the 12th of April and you fill in 0. And then you go to the next one. And this is how you manually can backtest something fairly quickly. So again, let's remove the drawings. We got the Asian range, we got the low of the Asian range, we got the high of the Asian range. And we still haven't had an entry yet. And there we go. So we can see a close below on a 30-minute time frame, which means this triggers the entry. This is going to be your last low pre-breakout. Stop and target it's going to be 1-to-1, 1-to-2, etc. Now this one probably is going to hit some type of target. There we go. So it hit 1-to-1. We're still in the position, by the way. And then at this point, you already want to highlight the second position. So this one is still running. It hit 1-to-1. So this is going to be your 15th of April. We did hit 1-to-1. This is still open. But then again, your next one, whoops, there was 15. This one is already running and you don't want to miss that one because you're already in a trade. So again, it's a mistake people make. You still want to take the next trade. And if this closes above, it did, then the last high pre-breakout is going to be there. So I'm going to put in an entry right here. Oops, it's going to be a long entry, obviously. Like that. And now we have 2 trades running. So that's really important, guys. Don't forget any trades simply because you're in a trade. And as you can see, this one hit 1-to-1 already. So you go to your spreadsheet, fill in one. And sometimes it can get a bit messy, but that's just part of manual backtesting. So hopefully that's clear. If you have any questions about manual backtesting at all, comment in the section down below and I will check it out and answer all your questions there. But this should allow you to manually test a basic, simple strategy and do some form of robustness testing to see, okay, do the exits work or not? And again, don't forget the costs.
Hey folks, what a view behind me. I'm at Black Bull Markets headquarters here in Auckland, New Zealand. Speaking of views, you can get TradingView paid plans for free at Black Bull Markets, saving you up to $600 a year. That's right, get either the Essential, Plus or Premium plans absolutely free, and all you need to do is trade from one lot a month at Black Bull Markets. And you can also get a 100% deposit bonus for your first deposit up to $1,000. All you need to do is click the Trading Nut link in the description below.
All right, so to quickly also show you an example of automated backtesting and what it can do and how much time it can save. Got a simple strategy programmed here. When I turn the script on, I immediately get all the trades. Every blue arrow is the entry, every purple arrow is an exit. I can quickly get the results. I can get the listed trades. I can export the listed trades and go from there. And this can be, automated backtesting can be done on TradingView, can be done on a MetaTrader, can be done on TradeStation, on different things. But this really allows you to, again, this is a very simple, basic idea to quickly see, okay, is there some merit in it? Do I want to test this further, want to develop it further? Or is it going to be a waste of time? So this allows you, like if your strategy is programmable, get it programmed because it quickly allows you to do a simple initial test to see if it's worth taking further. And again, look how much time I saved. I don't have to go back all this historical data. I don't have to use a replay mode, so I limit mistakes. Every single trade is going to be taken, and that's the power of doing things automatically.
Notes. Backtest from the 1st of January 2007 until the end of 2023 or something. And the reason for this is quite simple. If you only test a year, you might, by pure chance, test a year that fits very well with your strategy. So let's say you have a trend strategy and you test only 1 year where the market was trending. Of course, it's going to make money. But then when you have a ranging year, that strategy will lose money and sometimes even blow up your account. And if you only test 1 year, you have the positive results by pure chance, but not the bad results. If you test from all the way to 2007 until now, you have so many years. You have high volatility environment, low volatility, trends, ranges, everything is in there. And what you want to see over that period is not that it makes money in every single environment, but rather that it makes money in the environment the strategy is built for, and that it doesn't go to shit when there's a bad environment. So if there's a trend strategy, there's a trending market, it makes money. There's a ranging market, might lose some money, that's totally fine. But then when there's a trending market again, picks it up and makes returns again. That's what you want to see. Another thing there is going to be that you have a lot of trades. So 50 trades is not enough to evaluate if a system is profitable and if it's robust. So I highly recommend taking this serious, get a big enough sample size, test enough years to really get the full picture. The next thing is going to be make sure you use the right data and keep it consistent. So get proper data. Then don't go back over and over again to find the best settings. If your initial test doesn't work, just ditch it. The issue most people have is when they test something and they see, hey, there's a drawdown inside the backtest. Let's see if I can get the drawdown out of the backtest. So they go back, tweak something, test again. It's decent, the drawdown is halfway gone, let's test again. And what you're doing is you're building a better backtest. And by doing this, you're overfitting your strategy on past data. Now the past is going to look like the future. It's not going to be exactly the same. And by rerunning and rerunning and rerunning, you're tweaking your strategy perfectly to the past. And as soon as something is a bit different in the future, it stops working. So you don't want to do that. What I usually do is I have a very simple initial idea, such as the one I wrote down in the previous step. I do an initial test. I don't tweak anything. I don't optimize. And if I don't see some form of results there on the initial idea, I just ditch it. Because that means I need to be tweaking and optimizing. And it's, you can optimize. But if the basic idea didn't even work and the profitability fully relies on me going back and tweaking stuff and doing optimization and out of sample testing, I personally don't feel comfortable in the initial idea and I'm not going to trade it. That's how I do it. All right, so we find the best way to test it. You got the right data, you know what to do and not to do, start testing. And you backtest from this because, like I said earlier, you want to have the full picture. So make sure you use the right data, keep it consistent, don't go back over and over again. And since most of the viewers, like I said, use some kind of discretion, keep it simple. And I'm going to keep it simple because there is way more to backtesting than I'm going to explain here, because otherwise the video is going to be extremely large. So I'm not going to talk about walk forward optimization, Monte Carlo, etc. So it's really your simple idea, testing it and not tweaking too much. That's the basic thing that you want to be doing. A very important thing to note here is going to be that you want to include your slippage and your costs. Because trading is not free, it would be great, but it's not the case. And from my experience, that when you test something without trading costs, it looks absolutely amazing. And then you add trading costs and it just doesn't work. And that's, you might underestimate it, but it really is an issue. So include costs and slippage, do a basic backtest, have a simple idea and don't go back over and over again to prevent you from over optimization and curve fitting. If you want to go into the optimization, search for things like this to properly learn how to optimize. But to prevent curve fitting all in all, you might just not optimize and do some simple robustness testing. All right, analyzing results. So you did your initial test and you want to look at a few important things. Return to max drawdown. First of all, return, is it even profitable? And the second of all, is it worth it? If you make 10% a year and your max drawdown is 50%, that might not be worth it. I leave it up to you what you're going to use as what is worth it, what is not worth it, but you want to take a look at that. Distribution of results. If you have a strategy, you test it, you develop it, and it worked in 2007, 8, 9, 10, it made a lot of returns there. But the last 4 years, it hasn't made any returns. It's probably not the best because that means it works great in the past, but as of recent, it didn't. The next thing is drawdown recovery time. Now, for me personally, it's usually not an issue because I trade multiple strategies. And if I have multiple strategies and one is going to be in a drawdown for 100 days or so, I don't really care because I have more strategies. But you want to have something you're comfortable with. If you cannot handle being in a drawdown for 100 days or something, or 100 trades, first of all, it's quite hard to avoid it because most strategies will go through such periods. But on the other hand, if it's really something like 300 days or even 300 trades or 500 trades in drawdown, which some systems can be, you might want to ditch it, because if you cannot mentally cope with it, you're not going to be able to trade the strategy without mistakes. Therefore, you're going to run into issues when you trade your strategy live. So these are 3 very important metrics. All right, let's say your initial idea works, you tested it correctly on the right data, and you're happy with the results so far. What you then want to do is some form of robustness testing. And there is more to this, but I wrote down a few simple ways you can do this. What I mean by robustness testing is basically figuring out if the results you got here are robust and not by pure chance, because that's possible. What do I mean by robust? let's go back to the strategy. I wrote down, if the first 30-minute candle is bullish, buy at the close with a stop at the low and exit at XR. What you can do, for example, as a, there we go, parameter sensitivity test, is to take a look at, okay, if I exit at 1 to 2, was it profitable? 1 to 3, 1 to 4, 1 to 5, were these profitable? And you're not going to do that to find the best setting, but you're going to do that to see if your profitability doesn't solely rely on the fixed R you take. It should work with multiple settings, multiple R settings there. So that's what you can do. I filled in first 30 minutes. What if you use the first 45 minutes or the first 20 minutes? You want to check that as well. And if you then notice that, okay, regardless of whichever candle I pick, if it's a 30 minute, a 45 minute, it works. If I use a 1 to 3, it works, a 1 to 4, it works, a 1 to 5, it works, etc. That's a good sign. And that is basic robustness testing to make sure that your results are not by pure chance and that it's not based on a single thing. Next thing you can do is cross-market validation. Let's say you develop a strategy for the euro dollar and it doesn't work in the USD Swish, which are quite correlated. I would personally not be able to have confidence in it. So again, by pure chance, you might find something that works in one market, but then if you test it on a very similar market, it doesn't work. That's not a good sign. Now, this is quite a gray area, or it's nuanced, let me put it like that. Because if I develop a strategy for euro dollar, it works, and I test it on the S&P and it doesn't work, like that's fine. These are two completely different markets. But if you test on similar markets, you want to see some form of result in the other market as well. It doesn't have to be perfect, but if euro dollar goes up like this and USD Swish goes all the way down, like it's not really that good of a sign. You can also use a Monte Carlo simulator equity curve just to plot possibilities, maximum drawdown, etc. So let me show you how that works. All right, so this is an equity curve simulator, and this is the way you can figure out the worst cases and what to expect. Because when you do your initial backtest from 2007 until 2023, it's in chronological order, which means it's just the way time went. But what if instead of, we had this recession in 2008, we had COVID in 2020, there's time between them. What if they were behind each other? So what if we had the crash in 2008 and then COVID in 2009? Then you had a way different distribution of results. Because you want to do this because you don't know what's going to happen in the future. And by basically switching up the order of possibilities of trades, you can have a more realistic expectation of what can happen in the future and in terms of worst case scenario. So I filled in, I want to start with a 10K. I have a 30% win rate and a 1 to 3 average risk reward. It's profitable. I want to test the next 1,000 trades and I want to have 50 possible different outcomes, and I'm risking 1% or 100 per trade, 100 euros. The black line in the middle is going to be your average of all those 50 lines, which is clearly possible. As you can see, we went from 10K to 30K in 1,000 trades. That's a nice return. It's times 3. But when you take a look at lines here, for example, this dark green one, that's a worst case scenario. So that's a possible outcome based on your statistics here. And your backtest might show a very good result, a very nice equity line. But then when you switch up the order of the trades and test the possible outcome, you might have had something like this. Eventually, it's quite hard to see, but eventually it goes up, 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 and it made 100% gain in this period. Still really good, but you could have had that bad period. And using this can really help you to see, okay, what's the worst case scenario? What can happen? When you take a look down here, you can see biggest max drawdown. In your backtest, there might have been a max drawdown of 30% based on the chronological order. If you switch that up, it might go to 42%. You can use that to identify a worst case scenario. So when I click again, you can see the numbers change. And you can do this 100 times, 500 times to really get an idea of the worst case scenario and know how you can prepare for it and know what to expect. Right, so this brings me to the topic of optimization. And generally speaking, this is a difficult, very nuanced topic because almost every person that goes into backtesting, developing systems, does this the wrong way. Because what they do is, like I said earlier, they try to fit the strategy to the past. They try to build the best looking equity curve. They try to change too much, which costs you in the long run. Rule of thumb, don't optimize, or optimize as little as possible. I have a strategy that is unoptimized. There are better parameters based on my backtest. I'm just not going to pick the best one. I'm not going to optimize to find the best one. I did my robustness testing that goes more into this. I did it. It passed my robustness testing. That's it. I'm just going to trade it because you don't know if the optimized setting is going to continue forward. So generally, keep it simple and don't optimize at all, but do robustness testing, etc. If you're going to optimize, you need to use out of sample testing. So use walk forward optimization or another method. I do prefer walk forward optimization. But what you're going to do is basically, if you optimize, so let's say from 2007 until, 2015, you're going to find what worked best. And then you test what worked best on the next years to see how it performed there. So you have one training set of data, one testing set of data. That's the very basic idea of out of sample testing. But if you want to dive into this more, go to that. Generally, the more complex a strategy, the more likely you're curve fitting. If you have 5 different indicators and filters and things you want to see and you can optimize, it's way more easy to over-optimize and curve fit. If your strategy has unoptimizable stuff in it and just a few rules, it's less likely you're going to curve fit. The more optimized, the more likely your strategy is to fail live. Usually, your goal should be this. Build multiple decent, robust edges, some unoptimized, some optimized using walk forward optimization or something else you want to use. But basically, don't aim for the perfect curve because it doesn't exist. A good curve comes from combining multiple decent strategies. Having a strategy that does well in trends. Having one that does well in ranges. If there's a ranging market, your trend strategy goes down, your ranging strategy goes up, it evens out the results and gives you a better curve. The really bad thing to do is building one strategy and building a perfect curve there. Recipe for disaster, guys. Do avoid it. And then, demo and live trading. Trade your strategy on a demo, live, small live account. See if you can trade the same way as you tested it. So we have done all the testing. We have the idea. We know it works. We've done the optimization, possibly not. And we're at this stage. And now you want to see if you can replicate the results from your backtest and replicate the trades that should be taken in a live market environment. And if then you can trade without mistakes and you're satisfied with the results, then scale up, maybe get funded or whatever you want to do. But that's the step-by-step plan. One thing I want to note is that most people are scaling up without having done this, without having a working strategy, without having done the testing, without having done anything. They just learn something from YouTube. Let's go get funded. That's what they do. But really, this needs to go there because if you are funded without a proper strategy, you're going to lose it. And maybe you hit a home run, maybe you get lucky, but there's no consistency. So I hope this has been clear. I tried to keep it simple because there's a lot that goes into strategy development. So hopefully you get the idea. If you have any questions about this, comment down below. I will answer your questions. And then thank you guys for watching, for paying attention. And see you maybe next time.